Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. What I'd like to talk about this morning is the equity markets and what we see going on in the equity markets. The equity markets are pretty volatile right now, and although they're volatile, there still is an upward bias to this market, meaning we continue to keep making higher highs, higher lows on the NASDAQ and the S&P 500, and that's pretty good. So on the NASDAQ, it keeps straddling that 5,100 level. We're back above that, 5,000 level. We're back above that this morning. As long as it doesn't take out that 49.63, which was the low of last week, that uptrend should continue. Of course, if we do see it take out that 49.63 level on a closing basis, maybe we'll head back down to that 4,800 level. That's to be seen, but for now, the trend is still up. Same on the S&P 500, keeps straddling that 2,100 level. We're back above it now. As long as the S&P can stay above that 2077, the uptrend should continue. If it closes below the 2077, maybe we'll go back down to the 200-day, which is at about 2020 level, or maybe to the 2000 level. It's to be seen. Now, as far as the sectors, a lot of the leading sectors, a lot of stocks did get hit. It's earnings season, and if they weren't doing good, the market did punish them. However, despite this, the leading sectors still continue to be the chip makers, the semiconductors, of course, apparel makers, retail stocks, medical stocks, those still, and software security stocks, those still are your strongest sectors. So that's always something to look at. Now, as far as earnings go, out of about the 360 companies that reported so far in the S&P, 71% have beat on estimates, and about 46% have beat on sales. This is slightly below the average. One-year average is about 75% on the earnings beat. Five-year average about 73%, so it's only slightly lower. However, at the end of the quarter, March 31st, analysts were expecting the S&P estimates to come in at minus 4.7%, and right now they're doing much better, just coming in at a minus 0.4%. So that's much better, and a lot of that's due to the healthcare sector, which is strongly beating estimates, way above the average beat. And of course, energy sector, as we talked about, is lagging. Now, the energy sector did have a pretty good, say, 2 weeks showing a bounce, so that's to be seen where that goes. Now, some of the bigger moves last week that may impact stocks are copper prices and bond yields. Last week we saw a big bounce in copper, and it looks like copper may have bottomed in January. Similarly, we saw a big bounce in the 10-year yields, and what this indicates to us is either the market's pricing in future inflation or greater global economic growth, because this bounce in the 10-year yield was also tied to the sell-off in euro bonds and the bounce in the euro bond yields. So again, that's something to keep an eye on. Now, the most important event of that is that we're getting a steepening of the yield curve. And let's not forget, that's always very good for stocks, very bullish for stocks. So this is something to keep an eye on. And if it continues this way, it should be good for the market. Now, as far as the Fed is concerned, the market's a little bit, I think, overdone, and they're thinking, what's the Fed going to do? I want to say forget about the Fed. Rates are going to go up sometime. It doesn't really matter whether they go up or June or September, because they're not going to go up drastically. We all know that. In fact, it might be very good for the whole banking sector if rates do finally start going up, because then the banks may be more incentivized to loan and so forth. QE has basically done nothing but probably crushed growth. Maybe gave a vote of confidence, but it did nothing for growth. So my belief is raising rates would be a good thing for economy and be a good thing for stocks. So in summary, you need to take a look at all of these things. Take a look where the indexes are. Take a look how individual stocks are doing. Look at copper prices. Look where the yield on the 10-year is going. And forget about the Fed. But as always, let price and volume be your guide. This is George Kachuk, RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Good luck trading.